Precious metals miners saw spectacular price growth last year on the back of a bullion rally. So can this year prove any different? Joining me today in studio, Chris Mancini, analyst over at Gabelli Gold Funds. Chris, good to have you back in studio.
Thanks a lot. Thanks for having me.
Happy to talk about gold and the miners. But first, I just want to bring up Jerome Powell's testimony, since it was really the news of the day, him saying how the economy looks strong. But what I wanted to ask you is, George Milling Stanley recently had an interview with our reporter, Niels Christensen, and he said, don't get fooled by this rallying U.S. equities that we're seeing. There's still a lot of underlying problems in the U.S. economy. How do you see it?
Well, what I see is that the rally in equities is really being caused by low interest rates. So as we know, in around Christmas time in 2018, the stock market kind of crashed. And then the response to that by the Fed in January was a change in course. They started lowering rates, and they lowered rates throughout last year, 2019. And that's what's caused the stock market to go up. And I think that's what continues to have the stock market keep going up, is a view that, that rates have come down a lot, and that the next move might even be a lower Fed interest rate. And
right.
So I think that's what's really driving it, and not really a lot of underlying strength in the economy.
Interesting. So when we see gold move, up or down, right now, is it just responding to U.S. equities? So, for example, today stocks are up, gold is down, or is there a lot more at play here?
I think that gold right now is responding to interest rates and the view as to which way interest rates will be headed next. And so what's interesting is that because the gold price has kind of hung in here, despite the U.S. equity market just keep going up and up and up. And so I think what that's telling you is that the gold price is also saying that the next move on interest rates is flat to down and not up. Because if the economy were so strong that the Fed were able to raise rates, I think that gold probably would be down on a good day in the market.
All right. Turning to mining stocks now. I want to actually fire in a chart here that I wanted to share with you. This is from Fidelity Research, and it shows that if you had $10,000 10 years ago and invested in the S&P and precious metals equities, you would have $37,000 in the S&P, but only $8,000 in precious metal equities.
Yes.
So what do miners need to do here to turn this around?
Well, the main thing from that perspective is that they need to get involved in a chart that's when gold is at a bottom. And
right.
Because that in 2010, gold was at a high and peaking. And then the gold price declined a lot in 2012, and then 13 it had a real crash. The gold price did, and the gold equities still haven't really recovered from that. And so that's the first thing is get involved in a chart, have that 10 years keep moving out, because gold stocks have done well, as you just said, in the past year, and if you look by even 5 years, they've done okay. So that's the first thing. But from a fundamental perspective, what's changing is that the gold mining companies are now thinking of themselves as investment vehicles that generate free cash flow and can pay dividends. And what was happening in that period of time in the market was that they were just at a point where they'd been investing so much money because the market was looking for growth.
Right.
And they weren't returning capital to shareholders.
Well, you said the magic word dividends, and we're seeing more of that. Newmont recently announced a dividend increase payment by 79% to $1 per share. How will this affect its valuations?
I think that it's going to be great for Newmont's valuation in that, again, like if you're an investor in the gold market, you're probably thinking that the price of gold is going to go up. And so you want to be involved in something that has leverage to the gold price and where it doesn't cost you to actually own it. So like GLD, it costs you 40 basis points a year. They actually chip away at that gold in the safe every single year. Newmont, you buy Newmont stock, you're actually getting something in return. You buy for $44 a share, you're getting $1.
Well, the mining space has traditionally not been one to pay dividends. Very few companies do so. So what message do you feel it's sending to investors that we're seeing, companies paying out dividends now or raising existing dividends?
What they're saying is that these are investment vehicles, and they really need to be able to show that they're different from just owning the physical metal and owning the GLD and even owning the GDX, which takes a fee.
So is this new marketing, you feel, on the part of mining companies that needed to happen, that needs to happen?
It does need to happen. It's partly marketing, but it's also partly a result of really good operational expertise that they've been, in operational excellence that they've been doing here to try to be able to generate free cash flow, bring costs down, and do more with less.
You mentioned the ETFs, and many people would argue that gold ETFs have been a major threat, especially to the junior mining space. Are you seeing that?
Well, yeah, it's definitely a big threat because, like, from a GDXJ perspective, which is the junior ETF, they don't allocate capital to deals, and so, meaning equity deals. And so, if you're a company that's a junior mining company that needs to explore or needs to actually build a mine, when you go out and traditionally the way these are equity funded companies because it's very risky. So what's happening now is the incremental dollar is going from an investor is going into the GDXJ, not coming into our fund.
Yeah.
And so when a company needs capital and they knock on the door of the GDXJ doesn't participate in a deal, whereas we could, and we're thinking about it. Does this company deserve capital?
Right. Chris, do you think that there's more that miners should be doing besides paying dividends to convince investors, hey, we're a viable investment here?
From a producing company perspective, what they have to do is show that they can generate free cash flow and that they can accrete their net asset value. So meaning, they have to show that they can buy a project or even find a project and then for very little amount of money and then put a small amount of money into it and then grow it into a bigger net asset value.
You obviously see a lot of miners. So what percentage do you feel are properly doing that?
I think everybody's trying now.
Okay.
I mean, I'd say
that's a step.
I'd say 90% of the companies are trying.
Okay.
In terms of which are successful in doing it, that's a bigger question. I'd say maybe fewer than 60% are actually successful. I mean, but
that's a pretty high percentage.
Yeah. Okay. I mean, but it's also helpful in this market to be able to buy, because of the issues we're having with ETFs in the junior market, companies are able to fund, producing companies generating free cash flow, are able to fund junior projects or smaller projects in ways which they can accrete value to their net asset value. Because these smaller companies are trading at very low valuations.
So would you be in the junior mining space right now?
We are in a small way, but I think before we want to get bigger in the very small junior mining sector, we'd want to see a move in the gold price kind of through 1,600 and a view that we are in a bull market now and that hopefully other capital will come into the market. Because again, we aren't getting lots of flows, and so we have to be in a position where we understand that if we are funding a company, we're not going to be the only one there.
So is your preference right now to stick to the Newmont, the Barracks, the Agnico Gold?
Yes, those are core holdings in our portfolio. Those are the ones that, again, until we see something change, where the market again starts to realize that we need to put more money into active management, which can actually choose which companies to allocate capital to. The ones who are going to do the best are the ones that have the capital, and those are the cash flow generative companies like Newmont and Barrick and Agnico.
Now, how about the miners versus actual physical bullion? Do you have a preference?
The miners are the place to be. I think that they're cheap relative to the physical bullion price. They are generating lots of free cash flow. If the price stays here, I think that dividends have been going up. I think they'll continue to go up.
But Chris, it also depends on what you want to see from your portfolio, right? And if you're holding long term, or do you want to see, money coming in sooner, and you can be more speculative with your position? Yeah,
the way that I try to describe it to clients and potential clients is that the gold mining companies are going to be a lot more volatile. Right? So maybe if you were to have 5% of your portfolio in physical gold, maybe instead you should have just 2% in the gold miners. Take that other 3% and put it in Google or something like that, or other stocks which might be going up. And then you have a small percentage of your portfolio which is going to be very volatile, but has the potential to go up a lot if the gold price goes up.
Chris Mancini, thank you so much for stopping by in studio.
Thanks.
Always good
Daniela.
to see you. And thank you for watching. We'll have much more for you on Kitco.com.